Unlocking the truth, the surprising secret to proper portfolio diversification revealed. During a discussion about my trading system, the question arose regarding the ability to exit positions entirely and mitigate substantial drawdowns during a crash-style event. This particular circumstance has caused concern about the effectiveness of the trading method. The common response to such concerns is often centered around the concept of maintaining a properly diversified portfolio. When considering the question, the first thought that comes to mind is the importance of having a diversified portfolio. Diversification is frequently emphasized as a key strategy to manage risk in investment portfolios. By spreading investments across different asset classes, sectors, and regions, investors aim to reduce the impact of adverse market movements to their overall portfolio. These traditional ways to diversify include: number one, invest in different industries. Allocate your investments across various sectors such as technology, healthcare, finance, consumer goods, and energy. This helps mitigate the impact of sector-specific risks and allows you to benefit from the potential growth in different areas in the economy. Number two, consider market capitalization. Diversify your portfolio by investing in companies of different sizes. This can involve including large cap, mid cap, and small cap stocks. Larger companies often provide stabilities, while smaller companies may offer higher growth potential. Number three, geographical diversifications. Invest in stocks from different countries and regions. This helps you reduce exposure to the risks associated with a particular country's economy or political environment. Consider allocating funds to both domestic and international markets. Number four, asset allocation. Diversify your portfolio across different asset classes such as stocks, bonds, and cash equivalents. This strategy helps spread risk and balance potential returns. Bonds, for example, tend to be less volatile than stocks and can provide stability during market downturns. Number five, include different investment styles. Consider blending growth-oriented stocks with value-oriented stocks. Growth stocks typically have strong potential for future growth, while value stocks are often undervalued relative to their fundamentals. By combining both styles, you can diversify your portfolio across different investment strategies. And number six, allocate across market sectors. Within each industry or sector, diversify your holdings across different companies. This helps mitigate the risk associated with investing in individual stocks. By holding a mix of stocks within each sector, you reduce the impact of any single stock's performance on your overall portfolio. One question arises: do traditional diversification methods truly work? In a crash market, the underlying stocks become correlated. Let me show you. So you can see that there was a crash market here between March 6, 2020 and March 19, 2020. What happens in this crash market is that all assets become correlated. Gold down 12%, bonds down 11%, the market down 19%, the tech sector with Apple down 8.8%. You look at the aerospace sector with Boeing down 62%. Look at the retail sector with Target down 5.4%. Look at the airlines. You look at Love, which is down 33%. Look at the oil industry, Occidental, OXY, down 60%. And you have the biotech industry down 6%. And this is just over, what, a 1 to 2 week period? This is called crash correlation. So not only do all the positions become correlated in a crash, but they are all making big moves against you. And what happens is you have your short option premium using this concept, and the volatility rises significantly, and your options that you sold become very high in price. And what ends up happening is you get margin called, and you are forced to liquidate at the worst possible moment. So when your account's down at the lowest level, that's when you've got to get out and take all your losses. It's important to recognize that in a market crash, traditional diversification methods alone may not offer adequate protection. The modern portfolio theory has been popularized as a way to quantify the traditional method of diversification. It's not that the theory itself doesn't work, it's the way that the theory is being applied by almost every money manager. Now, there is one kryptonite to modern portfolio theory, one thing that can attack all portfolios, even those maximized by the modern portfolio theory efficient frontier. The kryptonite occurs in the new market environment we find ourselves in. Recent events that occurred in August of 2015, February of 2018, and March 2020 are events that have not been seen since 1987, in my opinion. Now, these modern events are a recent change in the market. And what am I talking about? I'm talking about the modern crashes that occurred in the market. And these recent crashes have turned the way that modern portfolio theory is applied on its head. Modern portfolio theory relies on uncorrelated assets to maintain stability in the portfolio. But during these modern crashes, all assets became correlated. Now, why did that happen? Well, the answer is leverage and algorithms. There's so much leverage in the system that a small downturn can force deleveraging, and everyone wants to be first to get out. So the algorithms trigger panic selling. This panic selling causes a crash and a large volatility spike. This type of modern crash causes margin calls and forces one set of assets to be sold to cover the other set of assets. This means no normal asset is safe in a crash. When all normal assets are selling off and become correlated, the modern portfolio theory breaks down because it relies on one asset to be uncorrelated, because it relies on assets to not be correlated and thus protect each other. But all assets in a crash are falling. And this is why a crash combined with leverage causes excess losses, even with portfolios that are supposedly uncorrelated. To mitigate the effects of crash correlation and volatility exposure, alternative strategies may need to be employed. These can include incorporating assets with true diversification potential, such as non-traditional or alternative investments, or implementing additional risk management techniques like hedging strategies. During market crashes, crash correlation affects not only traditional diversification methods, but also those who sell option premium. The popular method of selling implied volatility through short straddles or short strangles with naked puts can lead to significant losses during a crash. For instance, in the March 2020 crash, a $1 SPX put option skyrocketed to $90, resulting in potential losses of $90 on a trade that aimed to earn around $2. Thus, a $10,000 trade could have resulted in almost $1 million in losses, causing immense financial stress. Maintaining diversification in your portfolio involves a crucial factor: understanding second-order Greeks, in specific, a Greek known as Vama. Vama is a derivative of Vega, which measures the sensitivity of an option's price change in volatility. When volatility is high, Vega increases, leading to a rise in option prices. Vama, on the other hand, represents the exponential growth of Vega. In simpler terms, it signifies that Vega, or the price of an option, can experience significant exponential increases when volatility expands substantially, as seen in the crash-type market conditions. By grasping the concept of Vama and its relationship with volatility, you can better navigate market fluctuations and strive to maintain a diversified portfolio. So I found this on Artemis Capital's website. That's Chris Cole's website. I have to give him 100% credit for putting this little slide together here. But you can see that at the end of the day, we are all volatility investors in one way or another. And you can see, if you think you're invested in these things and you're diversified, you could be long short equity, currency arbitrage, risk parity, global macro, directionally long, short biased, convertible arbitrage, any of these. What you're actually investing in, as you can see, is you're short volatility. You're this much short volatility. That's like 95% short volatility. The only way to diversify any portfolio, including all these portfolios that are very popular, is to be long volatility. Imagine a scenario where during a market crash, you hold an asset that genuinely offers diversification. Envision the satisfaction of witnessing your $10,000 position soar to close to $1 million. While this may be an exaggerated illustration, it highlights the potential gains that can be achieved by implementing the appropriate trade structure and capitalizing on the advantages of VAMA. By focusing on trade strategies that consider VAMA and its implications, you can potentially avoid the misconception at being adequately diversified while still being exposed to substantial losses due to the impact of VAMA. Another crucial factor in capitalizing on market crashes is the ability to exit trades efficiently through a single ticket order trade structure. During a market crash, it's essential to avoid legging out of trades, as this approach poses the risk of turning profits into losses. The process of closing one half of a trade while not simultaneously closing the other half can expose you to adverse directional movements in the market. I personally experienced this unfortunate outcome in early 2018, where a promising profit transformed into a substantial loss during a legging out scenario. To provide further insights on this matter, check out the video that will pop up at the end of this video. By understanding the importance of a consolidated trade structure during market crashes, you can aim to protect your profits and mitigate potential losses effectively. Another crucial aspect of maintaining proper hedging is being proactive in your approach. This means keeping your hedge in place at all times, as waiting can be detrimental. Since it's impossible to predict exactly when the market will crash, attempting to catch up by implementing a hedge after volatility has already spiked is a challenging and often unsuccessful strategy. Moreover, there's a high probability that volatility will revert to its mean before the hedge can be fully utilized if applied too late. To avoid such predicaments, it's crucial to adopt a proactive hedging stance. Ensure that your portfolio is consistently protected regardless of market conditions. Overall, achieving effective diversification and mitigating the impact of market crashes requires a comprehensive understanding of various factors, including VAMA, trade structure, volatility dynamics, and proactive risk management. By combining these elements, investors can strive for a more resilient and successful trading system. If you're a trader looking for trading consistency, if you keep changing your approach, looking to add one more rule that will get you over the top, I'm going to help you for free. Stay with me for the next minute or so. Now, who am I to make this claim? My name is Karl Domm, Karl with a K, and it took me over 20 years to finally succeed to become a profitable options trader. I did that around 2019, and I have publicly proven to be a profitable trader since I started sharing my P&L on my YouTube channel in May of 2019. Now, my larger options trading account started with $110,000 and now is worth over $165,000. And I'm the only YouTube instructor that shares my daily P&L, proving that I am a profitable options trader. Now, I've asked many other instructors to share their P&L, but they don't because they can't, because they actually lose money trading. And I'm frustrated with the lies being told. If you've ever taken an online trading course, I'm 99% sure that you're frustrated and that you've lost money following these instructors. And you already know that they don't share their P&L. Now, as far as trading myself, I just happen to have a passion for options trading. And I spent over 27 years learning and trading. And I'm not necessarily interested in the technical aspects of options from a scholastic point of view. I've been passionate about the most efficient way options can make me money. And this is my calling in life, as corny as that sounds. And I've even written a book on the subject, even though I hate writing. For some reason, trading ideas just flow into my head all the time, and I take those ideas and I spend hours and hours backtesting them. And after backtesting over 300 ideas, one of the trades I developed was a trade that I call the 2060. This is a proprietary trade I developed almost from scratch. I initially created a course to sell it, and I wanted to compete with these other YouTubers that were frustrating me with their fake claims. But what I've decided is I want to do what it takes to expose those YouTube fake gurus. And if I can offer something for free that is vastly superior to their paid products, maybe I could put a dent in their business, which in effect would be using my talents to help people. Because of this, I'm currently providing the 2060 course at no cost. And this is a full course. It's not a worthless free report or some piece of useless, non-actionable information. This is a full course with black and white rules that you can use to take action and learn how profitable options traders trade. This course is worth $495, but I'm giving it away today for free. See the link in the description to sign up for the course.